So will he or won't he? That's been the topic of discussion yesterday and then again today. The answer yesterday was no. Senator Rubio was not going to vote for the tax bill. Today the answer was yes, and the market responded. And so now with the odds much, much higher that this tax cut bill is going to pass the Senate, the market really took off. But it took off with a lot of volume and a big range with volatility down to extreme lows. I'm going to break all that down to see how much more we can expect before we start to see some choppiness here, at least in the short term, if not more of an intermediate pullback. So let's go ahead and get started. My name is David Settle, and this is my market outlook for today, Friday, December the 15th, 2017. Thank you very much for watching tonight. Welcome to those that are watching for the first time. Subscribe to my YouTube channel by clicking that red subscribe button that's right down here below the video. Also, hit that thumbs up that's right next to it. Let me know that you liked the video today. You want me to do it again tomorrow. It's a one-click, easy way to give me feedback there. Scroll down further and comment on anything that stood out to you from tonight's video, anything that you learned or picked up that you didn't know before or that you were reminded of. Also in the video description, you'll see a bunch of links down there. Subscribe to my daily email newsletter that I put out in conjunction with these videos by clicking on that link in the description. Follow me on Twitter for more content in addition to these videos throughout the day, throughout the week. My handle's at the top of the screen at DavidSettle42. Pinned at the top of my timeline is tonight's Market Outlook tweet. Make sure you like and retweet that there. Finally, join the Market Outlook community on Facebook. You'll also see the address at the top of the screen, as well as in the video description down below. All right, before we get going too far here, I did want to kind of explain these tweets. So we're trying out different webinar software packages for our classes that we plan on offering here in the new year with a new company. Brandon and I. And so as we're trying these out, we thought the best way to try them out is to do some test runs with you, because it's really, what matters to you is the most important thing, because you're going to be the user. We'll use whatever is easiest for us to put a webinar on, but we can do that with anybody. We want to make sure it's the best experience for you. And so as I'm trying these out, like tomorrow's our first one we'll be doing with Google Hangouts. So business hangouts. So there's the link there to register. When you click on that link, it will take you to a page that looks like this. This is what it looks like here. When you register, all you have to do is click any one of these buttons that you already have an account with. So if you don't, you just do email, but you can register with your Facebook account, LinkedIn account, Twitter account. When you click on that, it'll open up a new window asking you to authorize Hangouts to be with that account. And then you'll get an email that you use to build up that account. So for example, I registered with Twitter. I've got an email address I use to start my Twitter account. It sent me an email to that address. And so in that address is the link. So once we get to, it's 10 o'clock tomorrow Eastern time in the morning, we'll go for an hour. So we'll go from 10 to 11. We'll just, somewhere before 10, and I'll be on there about 15 minutes beforehand, 30 minutes beforehand, just to make sure I'm working out the kinks. Just click on that link that's in the email that you got. There might even be a reminder email, and that's kind of what I'm testing out to see how the process works. So as you hit some hiccups, let me know. I'm going to have a survey at the end of the seminar, and that's the kind of stuff I want to hear is, how did it work with Hangouts? What did you like? What did you not like? As I make my decisions, or Brandon and I make our decision on what we want to use, your input is going to be a key factor on what we decide. So again, in terms of what we're going to talk about, for those of you who have been clients at my previous employer, it's going to be very, very similar to what I used to do on Saturday mornings. We get on and answer questions, go over what's happened that week in the markets. Anything that I talked about in the Market Outlook videos that you had a question on, that's the kind of stuff that you can come and chat in. And this is going to be basically a Q&A, moderated by myself, so I'll have some input on some things too. But I'll be going over some of the things that you want covered. I sent out an email to our subscription list. There's a link there. If you have anything ahead of time you want me to consider, there's a link to a survey, just one question survey to let me know what's on your mind and what you want me to cover as well. So Again, that's for those of you who have subscribed to my daily email newsletter, which the link to do that is down in the description of this video below. So let's go ahead now and take a look at the S&P 500. And just a quick reminder again, to make sure you're getting news announcements like this, make sure you subscribe to the email newsletter. Make sure you follow me on Twitter. And there's my Twitter handle. And then that follow button's right there. And again, the more you might not seen that tweet that I put out there today because maybe you just weren't on at the time that it came out. And that's okay, but if you want Twitter to push this to you anytime you log into Twitter, then you have to, make sure you're liking and retweeting the tweets that I do put out there, because Twitter will push to you the stuff that you engage with the most. And the easiest one is always pinned at the top. Just like and retweet tonight's market outlook tweet, and anything else that you like that you want me to keep doing. But that's the easiest one to find because it's always pinned at the top. Just like and retweet that, and then that way Twitter will keep pushing you stuff like this so that you know what's going on. Alright, that being said, let's take a look at the S&P 500 now. So you'll see we bounced up today, and this is a little interesting. So similar to this move here, see we were already above the moving average quite a bit, similar to right now. But you notice this bounce where it brought the near-term line, still 2 days, it was a bullish near-term high. This is also potential bullish near-term high. We talked about that yesterday too. The only difference is we have an extreme momentum line drop, similar to what we have here. Now that one produced a weak bearish posture. The idea was that one could too. So we'll see how that plays out here with today's move. Definitely taking away that long upper shadow that we saw and closing more towards the high. We'll look at that here in just a minute. But you notice, so now 1 day after the low, so here's 1 day after the low, the near-term line still below 50, and you'll see that we're still, not too bad away from the 30-day moving average. Well, here's 1 day after the low point, and you can see we're pretty far up above the moving average already, and we haven't even started, the near-term line hasn't started to get above 50 yet, because that's when we start the countdown, right, of how long a near-term run could last is 7 to 10 days. You see when you're close to the moving average and we get a bounce off, then there's, we got the potential to run for a while. And even here you can see we were pretty decently above that, and we had a decent intermediate near-term run, didn't get very far away from the moving average, and even pulled back while the near-term line was still above 50. So the ideal scenario is to get that near-term low point when you're close to the moving average, so we can bounce off of that and get going again. So that's why I think, again, this is a common theme I've been talking about. Yes, we have a strong bullish posture. Yes, long-term trend is very strongly bullish too. All that's still the same. Nothing's changed from yesterday or the day before that or the day before that. But I don't expect that this near-term run will last. So you can see, like we said here, we didn't expect that one to last very long, and it didn't. It lasted 4 days before we had this near-term pullback. Same thing here. I expect that we'll get shorter near-term runs as we now enter the, almost 4 months into this intermediate trend without a significant, without a significant enough of a pullback. Now, when I say significant pullback, I'm not talking about like 20% drops. Right, I'm just talking about getting the intermediate line below 50. That's significant enough to start a new intermediate run. And that typically lasts 1 to 3 months, and we're in month number 4 of this one. So as you get to the mature end of that run, you start to get shorter near-term rallies, and you start to get deeper near-term drops. So and faster. And you can see if it wasn't for that bounce, that buy the dip bounce, that would have been a pretty deep drop on an intraday, had we closed at that intraday low point. So they get bigger, they get steeper, they come faster, but it doesn't change the trend. Even that wouldn't have changed the trend had we closed at that low point, because, and in fact, that would have been a really good bouncing opportunity immediately because of the extreme nature of that drop. We've seen that before in the past when you've had extreme lows, extreme drops from all-time highs. Typically, there are immediate buy signals. So we got a strong trend. Just don't expect, that we're going to bounce up another, we've gone up, 75 points in the last few weeks. I don't expect 75 points in the next few weeks. Right? I expect this to kind of come up and down and meander around through this. Taking a quick look at the Dow, you see a very similar story here. Another all-time closing high. Its near-term line still hasn't gotten below 50, so we're still, kind of in this same near-term run. That wasn't much of a drop like we saw on the S&P 500. You can also see too on the NASDAQ composite. We did bounce back up above 50, so much stronger move on the tech stocks. 1.17, and of course Russell 2000 benefiting the most from this tax reform. Big strong move higher, closing above all those high, or not above all the highs, but closing above all those candles. Significant move there, and significant that the near-term line never did drop into the reversal zone. So again, we're getting near-term volatility. Expect to see more near-term volatility. I don't expect an extended intermediate run here because we're still on one, and that we haven't ended, we haven't pulled back enough, we haven't exhaled yet. Just so when we're at the end of one, just expect more near-term volatility, ups and downs, ups and downs. And with this tax reform, which is really causing a lot of the ups, that whole buy the rumor, sell the news thing is going to come into play. Yes, we have some seasonality coming into December. Yes, for a lot of that, a lot of the tax reform, one of the sectors that benefits from the tax reform is the retail sector, which has really been struggling with the Amazon effect. Well, again, despite all that, yes, there might be a bullish bias to this near-term volatility. Just don't expect one of those near-term runs like this, or near-term runs like this one, that we pretty much went up every single day. There's going to be some ups, there's going to be some downs that make you question about whether this trend's going to last. There'll be some ups again that thinks you're right back on board. That's the nature of a weak-handed market, where a lot of people that are coming in right now haven't been in off of this low point. Right, they haven't been bullish from down here. They've been bullish from right up here. So they're looking to add and looking to keep it going and looking to get this kind of run from here. When the reality is they should have been in back here when the intermediate line was dropped below 50 and was starting to rise back up above 50. That is the definition of a weak-handed market. All right, as we take a look at the long-term chart, you can see it's as bullish as we've ever been on the S&P 500 on an absolute basis. Just keep that in mind, that I mentioned that on purpose, on an absolute basis, because you see right now the MACD is, what, 124 points, 124.7 points. That's the gap on an absolute basis between the 50 and 200-day moving averages. Right now, that is on a... we're at 2675.81, so we're going to put that the MACD, so that gap is 4 2.2% of the current level of the S&P 500. So to put that in context, if I were to come back, say over here, the last time we were this strongly bullish, and then we started to taper the QE3, and then you can see we still went up, but the momentum was starting to diverge, right? So at this point, when we were as bullish as we ever were during that QE3 rally, we were at a, what, 104.25 points, so 104.26, and on that week, the S&P closed that week at 1842.37. 1842.37. So that peak got up to 5 and that MACD there was 5 2/3% of the S&P 500, and you can see we had some volatility there, but we didn't change the trend. That was as bullish as we ever got. That's as far away from the 50-day moving average ever got from the 200. From that point on, you see how the 50-day started to catch up to the 200, or excuse me, the 200 started to catch up to the 50-day. So same thing here. We're really, really high, but we're not as high now. We are on an absolute basis, but on a relative basis, we're not as high now as we were even back at the end of QE3. So keep that in mind in terms of, if you're kind of got that perma-bear mentality that the market's up too high, has to come down. Yes, there's going to be some near-term pullbacks. Yes, there's going to be near-term volatility. We're talking about that. Yes, there's going to be an intermediate pullback to at least a weak bearish posture, because that's what it does. And we'll pull down to at least a 50-day moving average. We've done that twice so far on this trend. doesn't necessarily mean, as you see over here, that we have to tank and break that 200-day moving average anytime soon. In fact, we didn't even sniff the 200-day moving average. We did a little bit, but we didn't even sniff it for another 9 months. And even then, we bounced right off of it and kept going. And then really things hit the fan in 15 and 16. So according to past precedent, this does not mean that we're going to get this kind of move anytime soon. From a 3 green arrow standpoint, you can see we still got the 1, 2, 3 green arrows, right? We're well up in yesterday's move. We talked about never did get below the 8-day moving average. We still haven't got below the 8-day moving average. So from the time this mid-November where we are testing the 30-day moving average, that near-term run there, we still haven't. So the last near-term rally started here, and you can see it didn't last very long because, again, we were already above the 8-day moving average. And here, you know, and we were that far away from the 30. Here, we're that, you know, if I were to change that MACD here down below, MACD, and we'll change that MACD to the current price compared to the 30-day moving average. We'll take off the histogram. We don't need that. So here we are. So on this near-term rally right here, and let me put my, let me here. There we go. So on this day is when we touched the 8-day moving average. The near-term rally started right here. So it turned up, but these 2 days, the near-term line is below 50. These 2 days, we notice, look how high we were on that second day on above the 30-day moving average. You can see over there it's 37 points. The price was above the 30. Now, this is, you know, we're still not above, the near-term line is still not above 50 yet, right? So this is the second day, similarly over here, that we're below 50, and we're already 55 points above the 30-day moving average. And for context, you know, we're over here, you know, we got that far away, and we had a lot of, you know, we had some volatility show up. Over here, we got that far away, and that was a blow off top that started a multi-month sideways move. So, you know, we're kind of forming this kind of move right now, which also happened to be the 4th month of an intermediate rally that typically lasts 1 to 3 months. So we're kind of entering a similar blow off top mode right now that we had in February of this year. And here's why it's important to be aware of what you're trading, right? Because you'll see, this is SPY. You notice SPY is not getting up to all-time highs. SPX, wait a second here. SPX did get up to all-time highs. So, you know, reason why? Because of a dividend payment. SPY had a dividend payment today. Those only does 4 a year, and December expiration happens to be one of them. So just be aware of what you're trading. If you're trading SPY, especially if you're selling options on SPY and you happen to be running them up to expiration, which is not advised, but you know, if you are, then you have to be aware that that dividend payment will lower the cost of SPY. So in this case, we gapped down, even though the broad market itself gapped up. At the morning, SPY gapped down because the dividend payment lowered the cost. Now, eventually, this would be adjusted. Profit charts adjust for dividends, so this will be adjusted at, you know, because again, getting a dividend is a non-payment, right? I mean, yeah, the stock came down, but you got, if you own the stock, you got the dividend. So really, it impacts those option sellers and buyers because they might be, you know, looking to, you know, they might think that we should be up here, you know, above 267, and they're not because of the dividend payment. All right, but you can see lower high, lower low, slightly on both cases. We did finish at the high of the day. We did finish the week above last week's high point. So that's last week's high point there. We didn't, you know, we on SPY now, we didn't get up to a 4-week high point. Once it gets adjusted, we'll probably end up moving that up a little bit. And if you take a look at the 20 day, you see we need to move it up a little bit more from there to here. And then a couple more days, we're going to move it up to there. And then you'll see we'll start stair-stepping it up a little bit. So, you know, as we push up higher, we're also pulling this up too. And eventually, you know, we're going to pull it up to, you know, this low point and then that low point. So the question is, are we going to get up to 280, 273? If we don't, if we kind of stick around 268, because again, buy the rumor, sell the news, then we're going to have a much tighter range that could lead to that intermediate pullback. Otherwise, you'll get some near-term volatility within the top half of this, and that will be okay if that happens. So again, when I talk about the blow-off top that we had in March, see, there was no dividend payment here, so that's why it gapped up and stayed up strong. Very strong volume on that day. End of a 4-month intermediate run. We're seeing very similar here. 3 standard deviations move higher in volume. 139 million shares traded hands. The range today, 1.65 points. Put that in context, 1.65 is high. Higher end, the volume was off the charts according to the 52-week average range for the year. And so it's like, okay, I mean, that you could look at that as a blow-off type move compared to what we got in March. Now, this tax reform is still in the news. Doubt anybody's going to vote against it, so it's most likely going to pass. It will pass sometime early next week, supposedly. Anything can happen, right? So we don't, nothing's a guarantee. The market's pricing in that it's going to pass early next week. Once it does, was that when we'll start to get this kind of a move? Because the market spent the last month and a half pricing in that it will pass, and now that it will, now will we get this? That's obviously the question. You can see volatility is down as low as it's been in the past few months, down below 9.5 again. We saw that already earlier this week, and volatility bounced off of that. That's on an absolute basis, and on a relative basis here, you can see that it's dropped pretty sharply too. Again, back down to extreme lows, not to the 75%, which we've seen here before, but down below 80% is the extreme low point for the VIX compared to the 3-month volatility index, the VXV. So some pretty low volatility. Again, very reminds me a lot, barring the dividend payment, which throws things off a little bit on SPY, but reminds me a lot of what we saw on that March 1st, around that end of February, and then by the end of February 1st. Now, so whether today is March 1st or whether today is February the 28th or one of those last days in February, but that's the kind of mode that we seem to be in right now. Again, awaiting for this tax cut bill to pass, and then, after we've been buying up this rumor for so long, now what's the next thing? Now, actually, there's rumors of an infrastructure bill that's going to be going, that could very well impact commodity prices, which one of the things I'll talk about, I'll show you here in a minute, one of the things the commodity price have been lagging behind. So there could be another thing that's out there that the market can buy the rumor for, as we anticipate. We've had healthcare, we've had tax cut bill, and now eventually a potential infrastructure bill that keeps, it's like quantitative easing, right? It's like we had with the Fed. We had quantitative easing. The market kept going up and up and up and up and up in 2014 and through 2015. We're to the end of 2015 at least. We're getting a very similar phenomenon right now, but with fiscal policy instead of monetary policy. Now let's transition to what's driving the price action today, and you can see if I were just looking at, well, actually from this, let's go from the close here and see what's performing the best today. And of course, one huge outlier, and mainly because it was the biggest loser heading into today, but that was our biggest gainer. IWM really taking off, pulling back at the end of the day, but still. So long upper shadow, a little bit of a long upper shadow, but still a pretty decent move. Whereas everything else is kind of flat. You notice, in fact, long-term treasuries outpaced, including the gap. And now remember again, there's a dividend that's pushing that down. But long-term treasuries outpaced all these others, emerging markets, developed markets. Everything was up, but treasuries was up more than any of these other asset classes. If I were to put, again, SPX in here instead of SPY, it doesn't have the dividend payment, then you'll see a little bit of a difference. You can see that gap there, number one, but there you go. As there's a large cap stock index doing really well. So again, that kind of puts it in the context. But again, if I were to take a look at from the time the FOMC came out with their rate decision, there we go. Treasuries are actually still the best performing asset class since the Fed. Because again, remember the Fed was kind of dovish in their statements, and in fact, to the point where, again, here's the we've already had the rate hike in December now. But you can see now the odds of no rate hike in March have really spiked back up. They were dropping considerably. They were at 60% here as early as last month in November, but they've been steadily dropping, and the odds of getting one rate hike in March were up almost to 60%, so almost high probability chance. But and with the odds of a second one potentially kind of creeping up there, and that's really dropped off. In fact, even the odds of not having any rate hikes by June, which again is that purple line, look how it's still at 20%, but it jumped up considerably. And the odds of getting one jumped up too. So if we're going to, according to the Fed Fund futures, according to how the market's reacting to this, what they're saying is, look, the market was expecting 2 rate hikes, and one in March and one in June, because of just of this phenomenon of how bullish economic indicators have been. This insanely bullish. And even today, industrial production continues to grow at a strong year-over-year clip, almost 4%. Coming up, when it was negative after QE3 ended, now you can see it's ramping back up again with monetary or fiscal policy accommodation. Whether or not, that can be argued whether or not we're in an economic environment where we need fiscal policy accommodation. Regardless, we're getting it, and you can see the response to it very similar to the response that we had to the fiscal monetary policy accommodation. So we are, the market's saying, okay, dial back the expectations on that March hike, but we're probably going to still get one in June. There's still pretty decent odds that we'll get at least one in June. So you have to add these two together, because the gray line is the odds that we'll get 2. So the purple is the odds that we won't get any by June, and so that's at 20%. So basically we have about 80% odds that we'll get at least one by June. And again, the odds of getting one by March were pretty high, and they're dropping. And so now it's almost 50-50 that we'll get one in March here. And I did want to point out this tweet here. It was an interesting chart in terms of the different asset classes and how they performed year over year over year. And you can see, the S&P 500's had a good run. The QE3 was right there. We started the taper in 2014. And then you can see S&P was the top gainer in 2015, even though it only went up 1.4%. Treasuries have been doing pretty well, and the S&P still had a couple, it's had a couple of good years since then, again, mainly because of the election. But you notice what has not been having a good run of things, besides 2016, is this commodities. Look at commodities. Really, since 2010, we had that kind of jump up higher. They've really been they've been the worst performing asset class since then. And so that's kind of why we're really not at that's something that's also in here. I don't ever really bring it up. But if you go to this boom bust barometer, which basically looks at the prices of these commodities and how expensive they are, and it's a proprietary thing to Yardeni where we get this from. But you can see we're not, because of that drop in 2014 through here, we're not nearly as to that point. And you can see even at the end of 2007 when the market peaked, we were at a higher point than where we are now. So and as the market started to pull back, commodities still kept going up. So we're getting there. We're getting up to those levels, but not quite there yet. And as when it gets to these levels, and that's when things really hit the fan. Things really hit the fan in 2008 in the fall, and things really hit the fan in 2011 with the credit downgrade, because our commodity prices were so expensive at the time. So if you take a look at the market here, and you can see, the biggest winners from a sector rotation standpoint was financials. Financial sectors, even with, without yields really taking off, financials doing very well. You can also see technology's up there, healthcare's up there, real estate and staples are up there. The biggest losers were energy stocks, interestingly enough, and utility stocks. So those aren't, typical losers, but you can see they've had it's a bad run over the last couple of weeks, including today's drop. And it kind of shows, again, those commodity prices, those are the things, they'll start to pick up at the end of a bull market. So, whether or not this is the We might be having a blow off top potentially similar to what we saw in March and into February, but that doesn't mean we're going to change our long-term trend. Like say the top that we had in 2007, where we did enter into a recession and a longer-term bear market. We're not looking for anything like that yet, mainly because we're not getting the run in materials and energy and these commodity prices to where they're the best performing sectors, and they typically lead at the mature end of a bull market. Similarly, you see a lot of short near-term volatility at the mature end of an intermediate run. You tend to see outperformance from materials and energy consistently at the mature end of a bull market, because those commodity prices are getting excessively high to where they're restrictively high. All right, with today's trade idea, I want to take a look at a stock that was in the news in that technology sector. It's outperforming, and that's Oracle. Oracle came down to this 47.5 low point that's been a low for the last so many months. Hasn't been doing anything for the last so many, even though the broad market itself has been on this 4-month intermediate trend. But you can see today after earnings, we gapped down, went all the way down to 47 before closing back up to 48.30. That's a significant level where we dropped to, because if you take a look at it on the long-term basis here, where we've been so far up above its 200-day moving average, because it did have a good run earlier this year, we've basically been consolidating, and you can see there's some support here at the 200-day moving average right around that 47 level. You can see there's some more support at 45 based on these old highs down below that. So you say, okay, well, if I were to say sell a put at 47 and then buy one at 45 in case it breaks down the next layer of support, then that caps my loss to $2 minus the credit I'm getting. But that's not enough credit to justify the risk of getting into that trade. It's a pretty decent odds of success, but I'm not getting enough credit. I would like to get closer to that 30% return on risk, because again, here we talked about yesterday the danger of going for too less credit, or too little bit of credit, because again, I'm getting 31 bucks. If I let this thing go until we cross that midpoint there, even though I've got support and here at 47, but if we were to break down, there's still more support at 45. We get down below 46. At that point, when time decay starts working against me, I've almost got double the loss that I'm trying to get on a gain. We don't want that. Remember, we want the loss at that point, at that juncture right there, to be about the same as what my gain is. So that way I know, okay, I can get out there and I can take a small loss and recover from it with only one trade. Here I got to take 2 trades to recover from it. So ideally we'd say, okay, well let's put this trade through then, because confirm it's done. Nope. Edit. I'm going to edit that trade. There we go. So we're okay with getting into this trade, but it would be ideal, considering that we pulled down to 47 today, we could continue to trade around here. So we say, okay, well, if we do, then let's put a limit order, not a stop limit. A stop limit means I want it to go, and this is a bullish trade, so I want it to go up first before I get in. Here, I want the trade to come back to me a little bit. It's at 31 cents. I want it to come back to me so I get more credit. And so we're going to put a limit order here of about 45 cents. 47 is that ideal. That's the 30% return on risk, but we'll stick with a round number here and put a limit order at 45. So now I'm not going to get in. You notice it's got to pull back down to this 47.5 area, theoretically, before I get the credit I want to justify. I'm still going to get a decent reward to risk ratio here. It's going to be around 60% plus. But now I get a better credit. All the technicals all still there, right? You still got support, you still got the 200-day moving average. You take a look at the 3 green arrows. I mean, yeah, you got 3 right here. You got 3 red arrows, but typically when you get 3 red arrows and a spike in volume, it's hard to, big spike. It's hard to keep going down. We saw that before last earnings. It stopped going down at 47.5. So it might go down a little bit more like it did there. If it does, then we'll get filled in at that credit we want, and we'll see if it continues to bounce back up from there. So to summarize, the market continued higher today. Today was a big day, barring that dividend, ex-dividend. Today was a big day with a lot of volume. Have we bought the rumor enough? Was this the last of it? Are we getting the March 1st move today? Are we going to continue to grind into some near-term volatility, not trend-changing volatility, but some near-term volatility where we start to maybe even break down into the lower half of the 4-week range, Not break through to lows, but breaking into that lower half and kind of testing things around a little bit. So that's kind of what we're looking at, expecting here in the near term. But despite all that, we can take advantage of that with stocks that are doing extreme moves, like we saw with Oracle. On one extreme, there's a move like Microsoft, and the other extreme went way far up to the upside with a lot of volume. And did it blow off too much move to the upside? So, there's different odds at the extreme. We can take advantage of that, and using technical analysis combined with how you trade and sell options, to be able to try to find good high probability trades in this kind of grinding environment. So thanks again for watching tonight. Remember to come if you got some time tomorrow morning. Love to have you help me try to figure out this webinar software and give me your input on that. And while we're at it, we'll talk some stocks tomorrow morning. Remember to subscribe, like, and comment on the YouTube channel. Follow me on Twitter if you haven't already for more content. And of course, join that Market Outlook community on Facebook with the address in the description of the video down below. Have a great evening, everybody. Have a great weekend. If I don't talk to you again, we'll see you all on Monday.